because I do think we could have new record highs in the price of gold by Friday. We did get a new record high in the price of gold today, just barely. I think we touched 3,700, but it was a roller coaster ride. Silver was down almost $2. Like, there was a big sell-off. Silver almost got to 43 yesterday. And before the open, there was just, I think they really rushed a lot of the stops, and they had a big drop in silver, almost $2. And a gold was down like $30, $40. But then it was up like $30 after the news came out. So it went on a roller coaster ride, but it only closed down about, I don't know, $20, $30. So gold's around $36.60. I mean, not too far below the record high.
In today's news recap, gold moves to new all-time highs. In September, gold rose to new all-time highs, approaching $3,700 per ounce. The upward move reflected several factors. First, U.S. President Donald Trump fired the head of the Bureau of Labor Statistics and also moved to fire Federal Reserve Board member Lisa Cook. Trump's actions have raised concerns about the independence of U.S. economic institutions. The implication is that interest rates may be held at inappropriately low levels for an extended period, making gold even more appealing. Second, U.S. labor market data deteriorated and the U.S. 2 to 30-year yield curve steepened as a result of this. The steeper yield curve implies imminent Fed rate cuts in the near term and higher inflation levels over the longer term. Gold will benefit from such a scenario because it implies that real inflation-adjusted interest rates will decline. This is already evident to a small extent, and we think that threshold effects will kick in if real yields, proxied by 10-year TIPS yields, fall to levels of below 1.50%. We note that long-end yields have continued to rise in most advanced economies, and this dynamic also reflects rising term premia, which is the extra compensation that investors demand for increased inflation and interest rate volatility. Causation is key in this regard because gold will respond positively to an environment of rising term premia, especially if the driver is increasing inflation expectations. The upshot of these developments is that continued price rises are to be expected. We think that gold will rise to levels of around $4,000 per ounce by mid-2026. Rising gold prices have also served to drag silver towards higher levels of above $40 per ounce. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
There were quite a few gold stocks, that closed positive on the day. They were down quite a bit yesterday, even though there was just a small move down. But I think that this rate cut and the fact that we're getting two more at a minimum between now and the end of the year, that I think ensures smooth sailing for new record highs. I still think we have a good shot at hitting $4,000 gold by the end of the year and $50 silver. So right now you still got quite a bit of upside in both, especially silver is now back below 42. So you got about a 20% gain between here and $50. That's not bad. Now, of course, I don't think silver is going to stop at $50. I think it's going much higher, but it may not get much higher this year. So I think by the end of the year, that's a realistic target for silver. So I would buy it now, shiftgold.com, right? We don't just sell gold. We sell gold and silver. But the mining stock charts look even better to me. The GDXJ hit a new, I think, record high. It finally took out its high from 2011. But the GDX, which has been acting stronger of late, still needs to rise about 60% from here, I think, to get back to its 2011 high. But based on the chart, it looks like it's going to go there very quickly. So I would be buying these stocks as quickly as I can. My favorite way to participate is my own gold fund, the Euro Pacific Gold Fund. EPGIX is the no load symbol. You could pick that up anywhere. And I'm not just saying you should buy gold stocks or my fund because I make some money. Of course, I don't make any money if you just buy gold stocks at some random discount broker. But I'm happy regardless. But I think our fund has a lot to offer, and I think we're going to outperform over the long term. But the real reason I want my audience to buy them is because I think you're going to make a lot of money if you do. It's not that there's no downside risk. There is, but I think it's minimal when you compare it to the upside potential, which I think is enormous. And unlike the Fed, I have a lot of confidence in my forecast. I'm very sure that I'm right. I don't guarantee that I'm right, but I think I am. The Fed has no clue, right? But my forecast is not just a guess. Right? It's based on my understanding of monetary and fiscal policy that apparently is lacking at the Fed. Someone says, wow, you must be rich. And then the mother says, no, he's just kidding. Nobody has two TVs. And the reason nobody had two TVs was because they were so expensive.
In today's precious metals news recap, UBS says silver poised for all-time high as investors flock to precious metals. Silver prices have surged to $42 an ounce, a 14-year high on the back of record gold prices and a wave of investment inflows. Following the rally, UBS has raised its forecasts for the metal, saying it could reach all-time highs in the coming year. The bank now forecasts silver to trade at $44 an ounce by the end of 2025 and climb to $47 by mid-2026, aligning its outlook with a recent upgrade to gold. We flag that silver prices could reach an all-time high, a view that supports a long position in the metal or selling its downside risk for yield enhancement, strategists Dominic Schneider and Wayne Gordon said in a note. The rally comes despite sluggish global industrial activity, with investors drawn to silver by the same macro forces propelling gold. UBS pointed to geopolitical tensions, U.S. fiscal deficits, slower growth, and the prospect of Federal Reserve rate cuts as drivers of demand. Silver's strong correlation with gold, typically between 0.5 and 1, has amplified these effects. Exchange-traded fund inflows underline this trend. UBS highlights that silver-backed ETFs have added more than 20 million ounces this quarter alone, bringing this year's total close to 80 million ounces. While significant, holdings remain more than 200 million ounces below their pandemic-era peak in 2021. Looking ahead, strategists see silver benefiting further as monetary conditions ease and investors look ahead to a cyclical recovery. The team expects the gold-silver ratio to decline toward 80, supporting relative outperformance for silver. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
A bit of an up move in interest rates on the long end. The 30-year closed a little higher on the day, and that's been my forecast. The 10-year is 4.09. A couple of days ago, it was down to like 402, 403. I think we're headed higher from here. Right? I don't think the long end of the bond market is going to react positively to the Fed cutting interest rates when inflation is not only well above 2%, but headed in the opposite direction. The stock market, again, hit record highs. I think the Dow Jones hit a record high today, and it closed in record territory above 46,000. Dow was up 260 points today. The NASDAQ was actually a little bit lower on the day, as was the S&P. Neither hit record highs. It was just the Dow. Russell 2000, not a record high, but also up on the day. But overall, the stock market likes the news that the Fed is cutting interest rates. But I can assure everybody that this is a major policy mistake. This is going to go down, I think, maybe as the biggest mistake. And that's saying a lot because they've made so many big mistakes, like the ones that led to the 2008 financial crisis, inflating that housing bubble, and the mistakes over COVID that led to the transient inflation that wasn't transient. So they've made a lot of mistakes cutting rates, and this could be the worst one because inflation is headed much, much higher, and they've already put themselves on a preset course to cut rates, and they're not going to change from this course because they know what it might mean to the market. So they're going to have to rationalize all the upticks in inflation and attribute it to the one-off effects of tariffs. They probably don't want to say transitory, so I guess they'll come up with another word that means transitory, like with abundant and ample. Maybe, you know, not transitory, what transient or temporary. I don't know, whatever. They'll come up with a synonym that means the same thing, but doesn't quite subject them to the same degree of ridicule. But you got to look through all that, and you got to load up on inflation hedges. All your investments, I think, should be non-U.S. dollar. The dollar's got a one-way ticket down. You don't want to go down with that ship. You want to abandon ship, and you want to buy foreign stocks that continue to eat the lunch of the U.S. stock market year to date, despite the fact that it's hitting nominal record highs. So you want to, you know, all the Euro-Pacific funds, I think, are great. The dividend payer fund, the value fund, the emerging markets, I think, are going to be the stars of 2026. You know, just my value and dividend payer funds are doing better this year, but I expect a major move up in emerging markets next year and the year after that and the year after that, because I think that it's the transition is out of U.S. markets into international markets, and then it's going to be from developed to emerging markets, but all of it non-dollar and commodity focused. Energy, I think the energy prices are still low, so energy stocks are still very cheap. Maybe not as cheap as the miners, but they're still cheap. We still have good allocations there. So just brace yourself. The Fed is, you know, waving the checkered flag. We know how this race is going to end. You just got to position yourself. Anyway.
What do you think of his take? Do you agree with him? Is a big rally coming for gold and silver before a big top forms, or will gold and silver outperform all expectations? Let us know your honest opinion in the comment section down below. Smash the hype button if you enjoy our recaps, and check this video right here because you'll love it. I'll see you on the other side.